A lot of people think of multifamily investing as the big leagues in the real estate investor world, and I tend to agree with them. In this video, we're going to talk about multifamily insurance fundamentals and how to help you make sure that you are well prepared for future losses and insurance claims. We're going to take a look at that and more here in just a moment. Hey folks, I am James Jenkins, Chief Risk Officer of RiskWell, and this video is part of the Real Estate Investor Insurance Academy, which is brought to you by RiskWell. We're going to take a look at the multifamily world of insurance here in this video. We're going to talk about some common things you need to be aware of, as well as some errors that are very common in multifamily insurance. We're going to jump right into the slide share, and I'd love for your comments, questions, feedback on this. We'll have that as the wrap up here for this video. So let's get started with our screen share and jump right in. Some of the sources of risk in multifamily properties are simply going to be the tenants themselves. More tenants equals more possibilities for shenanigans, for people doing stupid things and getting themselves sued, which means you get sued right along with your tenant, most likely. It's a best practice to require all of your tenants to carry renter's insurance, as well as naming you as additional insured as the lessor of the premises. You know, it boggles my mind still to this day. There's so many investors out there that are not requiring their tenants to have renter's insurance and name them as additional insured as a part of the lease agreement. There's no faster way for you to get in hot water than to take on the added exposure of your tenants doing dumb things. Happens all the time. It's a great way for attorneys to get a hold of your money. Also, source of risk, if there's a common area, mail building, pool, playground, storage units, detached carports, garages, anything on the property, you're going to want to make sure that your policy is contemplating those exposures and providing the appropriate coverage for them. Not just for a property coverage, but also for liability coverage as well, especially with regards to pools, playgrounds, and self-storage units, which are pretty common with a lot of properties. You're going to want to make sure you pay close attention to the number and the valuations of each of your buildings. And in the deductible side of the conversation, make sure you understand exactly how deductibles are applied on your property, especially when you've got larger schedules of buildings, especially larger complexes. The deductible conversation can be really sticky and mean several $1,000s, potentially tens or hundreds of thousands of dollars in difference, depending on how your deductible is structured. Both valuation and deductible for each of the buildings in your property are a critically important part of your insurance program. Let's take a look at some of the errors that are very common for insurance agents and brokers to make. You're going to want to make sure that you are aware of these and you're paying close attention to your insurance program and policy details. The first is going to be missing coverage for elements of the property. If you have common areas or any of those other structures we just talked about, one of the most common ones that gets missed is fencing. Fencing is often overlooked as a part of the preparation for a multifamily insurance policy, so it really helps to have an insurance agent or broker that is asking a lot of questions and making sure they fully understand the nature and details of your policy and property while they are building everything. The next common error, as we just talked about a moment ago, is forgetting or neglecting to optimize the deductibles according to your risk tolerance. As a multifamily investor, you typically have a lot more options to play with in the deductible world, and in exchange for a cost reduction, you can take on more of the risk and have a partially self-insured type of exposure. Specifically for property risks, you definitely don't want to have self-insurance for liability risks. Those could easily be hundreds of thousands, if not millions of dollars, depending on what happened on the premises. Next is neglecting to include important secondary coverages, things like directors and officers, cyber liability, if you have in-house leasing, and property management, if they're on site, if you are taking care of that for the property. There's other exposures you need to make sure you're aware of, including equipment breakdown, depending on what exactly the nature of the property is, HVAC, if there's a boiler for heating, depending on where your property is located geographically, that may very well be a big deal. Next is going to be the neglecting of adequately addressing liability exposures and especially limits. If you've got a large property, your standard $1 million per incident, $2 million per year is not going to be sufficient. So you want to make sure that you are adequately covering those liability exposures in the insurance program. And that's it for our common errors. Any questions? Any feedback? Anything you think I missed? Any other conversations you'd like to have about multifamily insurance? Please drop a comment below on this video or reach out to us at our website, riskwell.com/consultation, by phone at 469-678-8001, or drop us an email at info@riskwell.com. Love to hear from you on this. This is definitely one of the more complex parts of the insurance world. If you get value out of these videos, this series on Real Estate Investor Insurance Academy, please consider subscribing to our channel, like the video, and share it to someone you think would enjoy it too. That's all for this video. We'll look forward to seeing you next time. And please remember, boys and girls, life is risky. Risk well.